Good afternoon, students. Welcome back to this discussion on audit. So we have been discussing about audit of various items of financial statements, and today we plan to continue with our discussion on the same. Okay, so in the previous session, we started with the trade payables, and in terms of trade payables, various other current liabilities which are attached. Okay, so both of these aspects we are now going to continue. So let's do a quick recap in terms of this trade payable that we started discussing. And then, of course, we'll talk about various other assertions which are linked to the trade payables in terms of the audit procedures which are attached to that. Okay, so trade payables. Now, as regards trade payables, and of course, let me just add other current liabilities. Okay. Now, first of all, as regards trade payables, we discussed that when it comes to the trade payables, so it's a cycle, and this cycle is attached to the purchases. Yeah, because if you will purchase, then there will be a corresponding liability for the same in the form of sundry creditor. Yes or no? Which is nothing but a trade payable. And till the time this liability is not discharged, that keeps outstanding, and that is presented in the balance sheet as a trade payable. Now, trade payables can be current or non-current. Generally, these are found to be current. Why? Because the credit period which is associated with the trade payable is generally 2 to 3 months, or we can say less than 12 months. So that's why this is generally an item which is current in nature. Okay. Now, as regards this trade payable, this is briefly about the accounting requirement in terms of how the trade payables are generated. Now, further to the trade payables, now because there's one leg of trade payable which sits in the P&L in the form of purchases, or you can say to a certain extent which will also form part of cost of goods sold, and the other leg is something which falls in the balance sheet, which we are discussing right now in the form of trade payables. Now, as around the trade payables, we discussed that it's mainly about the balance sheet component that we are discussing over here right now. Yeah. Now, if we talk about trade payables, and if we look at some of the previous items of the financial statements, in fact, the balance sheet that we have discussed so far, there was one audit procedure that we discussed, which is of significant importance when it comes to the trade payables. And we also briefly touched upon that procedure. And we discussed that whenever such procedure is involved in relation to any item in the balance sheet or in the P&L, that will always be considered to be of significant importance. So can you tell me what procedure was that, and what procedure you will generally associate with the trade payable as a significant one? Great. So Prem is saying it's the direct confirmations. Same is the response from Almas. Rihanna has the same answer. Okay, direct confirmations. Very good. Now, as regards this particular procedure on direct confirmations, I think we have already discussed this quite a lot. Yes or no? So we don't need to get too much into the details of direct confirmations, except for some of the points. Now, as regards the direct confirmations for trade payables, if let's suppose this procedure is required to be performed by you, in such a case, what do you think, that should this be performed on a sample basis as around the total population of the trade payable, or should it be something which should be performed for entire trade payables which are there in the financial statements and why. Okay, so please also let me know the rationale behind that. So if you say sample basis, why? If you say entire population, why? Yeah, so that rationale you need to include. Over to you. Now, what do you think will be the correct basis and the rationale for the same? Over to you. Quickly. Over to you. Quickly. Okay, so one response I've seen from Prem says it should be done on a sample basis. Yeah. Now, can you also tell me why do you think it should be done on a sample basis? Great. So Prem says sample basis because there might be a huge number of creditors. Rihanna says there will be a lot of purchases during the year. So that's why it's impractical. Yeah, or practically you can say it's going to be impossible if you plan to cover all the trade payables, particularly for large size companies or even for the medium sized companies. Almaz says it should be done on a sample basis as there will be many creditors. Okay, now in relation to trade payables, one point is very clear that it has to be performed on a sample basis. And what is the rationale? I think everyone has given the correct rationale that the number of trade payables may be quite significant. Okay, number of creditors could be quite significant. So it's not something which is easy for a company to manage that. It's going to be extremely difficult to manage such number. Yeah. So therefore, it becomes extremely important to first of all look at the entire population and correct the right sample from that entire population. Okay. Yeah. Now, in relation to the sample, now what are going to be the next steps? Of course, the auditor will send the direct confirmations to those parties. Auditor will also obtain the direct confirmations from those parties. If the parties do not respond, auditor will of course send the reminders to those parties. Yeah. If in case there are still some parties which are left who do not respond, okay, let's suppose everything is completed and let's suppose a total sample of 50 was selected. Okay, yeah, let's suppose a total sample of 50 was selected. Now, out of 50, let's suppose almost mostly have responded, 43 have responded, 7 are left. Okay, let's suppose 7 are left. Now, in this case, when 7 are left, yeah, now for these 7, despite the reminders, confirmation is not coming to the entity. Now, in this case, what do you think will be the course of action on the part of the auditor? Because audit has to be completed. There's a timeline. Yeah. So what should you do? I think Pawan has a request, but of course, see, please understand that the medium has to be English because it's like catering to all. Huh? Yeah, very, very difficult. I think Pawan, you need to manage this way. Rohan is saying alternate audit procedures. Prem says alternate audit procedures. Very good. So now can you also help me understand that what will those alternative audit procedures be? So when you say alternate audit procedures, what are going to be those alternate audit procedures? Yes. Rohan says sales and payment checking. I think you are talking about purchases, correct? So you are saying one, of course, the payment made to them subsequently. Okay. So payments made subsequently. So that is one that will be checked. And second will be the purchase invoices or the supporting documents. Yeah. Prem says inspection of transactions between the parties. Yes, of course. And that will be done in the form of the underlying documents which are there with the respective parties. And of course, the subsequent payments which are there. Correct. Yeah. So this is how procedures are required to be looked at. Okay. Now, in this case, once this part is looked at, okay, so now this is about the confirmation procedure. So let's move further. Now, in respect of trade payables, what are going to be the other audit procedures? So let's think about that. Of course, direct confirmations we have discussed. What are going to be the other audit procedures? Now, other audit procedures, once again, we will have to sort of, refer to the corresponding P&L item. Means the purchases. Okay, so now in respect of purchases through which trade payables have got built up, okay, which has resulted in the built up of the trade payable. Now, what do you have? One, cutoff testing. So that could be one of the audit procedures. Yes or no? Now, what is going to be the cutoff testing? Can you please explain that when it comes to the purchases, what will you include in the cutoff testing? What would that cutoff testing mean? How will you perform that cutoff testing? And please understand, when we are talking about cutoff testing, so we are talking about cutoff assertion. Yes or no? So we are talking about cutoff assertion. So how do you check that? Over to you quickly. So what do you think should be done in respect of cutoff testing? How will this cutoff testing be performed by the auditor? Ron says we need to look at a particular period. Okay, very good. Rihanna says check the last 5 invoices at the end of the year and first 5 invoices at the beginning of the year. Very good. So now in respect of cutoff testing, if let's suppose our financial year is ending 31st March 2025. Okay, let's suppose this is the financial year. Yeah, in this case, our objective is to ensure that the purchases pertaining to 31st March 2025, or we can say 24-25, have not been pushed to the next year. So how do you check that? How do you check that? We will pick up the first few purchases of the next year, maybe first 5 days, first 7 days. Okay, and of course, to begin with, first 5 purchases of the next year. Now, if all of these purchases belong to next year only, so that means purchases of 24-25 have not been pushed to next year. Correct? Then our next objective is to ensure that purchases of next year, means 25-26, have not been preponed, have not been booked in 24-25. So how do you check that? If at all purchases of 25-26 would have been preponed, in such a case, what would the entity have done? Entity would have considered the purchases towards the end of the period only. So it will not happen that the purchases of first week of April or say second week of April of 2025 will be booked in the first week of 2024. No. So if they will be preponed, they will generally be booked towards the March month or towards the end of the March month. Okay. So if you pick up this last period, okay, last week of March, or say last 5 invoices, last 7, 10 invoices of March, and you find that some of the purchases which are booked in March 2025 actually belong to next year. So that's a cutoff issue. If not, then of course the cutoff issue is not there. Clear? Yeah. So whenever it comes to cutoff, this is how cutoff is performed in terms of the testing. Okay. Now, if you do this, then of course the corresponding impact which could have been there on the trade payable will also got tested. Yes or no? Yeah. All right. So now, this was cutoff. What are the other assertions you look at in case of trade payables? Tell me. What are the other assertions we need to look at in case of trade payables? Over to you quickly. What do you think? What are the other assertions you'll check, you'll look at? Rihanna says valuation. Okay, so now by valuation, we also mean to say that whether the amount of trade payables is correct or not. Yes or no? So how do you check that? So I think Prem is saying one, you can always look at the opening balance, which will be traced to the previous year's financial statements. Traced to previous year's financial statements. Yeah. So with this, opening balance is sorted, checked. Then you will look at additions or deletions during the year. So what would mean additions? Additions means purchases during the year. Yes or no? And deletions? Deletions would mean payments made during the year. So that's how deletions will be made. Correct? So for purchases, payments, we have already looked at that on a sample basis, invoices will be picked up. Okay. But of course, we can also include that audit procedure, that sample testing of purchase invoices, purchase transactions, through the invoices, through the agreements, through POs, through various other supporting documents are required to be verified. Yes or no? Yeah. So that's how you will check as to what are the additions. And in terms of payments, that again on a sample basis, you will go look at the bank statements whether the payments have been made during the year or not. Okay. So that is about the additions or deletions. Then the closing balance. Now in terms of the closing balance, one, of course, this closing balance is nothing but a built up of opening balance plus additions less deletions. Okay. So this is in a way derived through this. Okay. In a way, this is derived through this. Further on the closing balance, we have already discussed a confirmation procedure, because confirmation procedure will also help you in terms of the closing balance. Correct? Then various other procedures that we will perform, for example, cutoff, okay, or for example, some of the procedures in relation to analytical review. They will also help you in terms of assessment as to whether this number of trade payable is correct or not. Yeah, correct. Okay, now valuation we have talked about, cutoff we have talked about. Okay, of course, completeness in a way we have discussed. To a certain extent, existence we have also discussed because confirmations are being sent. So that will take care of the existence. Now, what comes next? Great. Rihanna says discloses, of course, and rights and obligations. Yeah, so let's talk about both. Another assertion is rights and obligations and presentation and disclosure. Presentation and disclosure. Okay, now this is another one. In this case, when we are talking about rights and obligations, okay, when we are talking about rights and obligations. Now, as regards rights and obligations, what are going to be the audit procedures? See, because there's an obligation, so how do you establish the obligation? By the supporting documents, by purchase order, invoices, agreements, okay, credit notes. Yeah, some of these things you'll look at. Yes or no? So that's how you will do this. Yes or no? That's how you will do this. Correct. And of course, in respect of various procedures that we will perform that we have already discussed above, some of these things will get covered. Now, moving on to the next procedure, presentation and disclosure. Can you please explain what procedure is this? Because I think this procedure has been discussed quite a lot. And we have also discussed that it's a standard one. Okay, so everywhere it's going to arise. Can you please try to elaborate on this? Instead of giving just one liner, can you just help drafting this audit procedure as to how you will draft this? Quickly, over to you. In terms of this audit procedure, what will you do? How will you do this? Yes, quickly. On the presentation and disclosure, what will you do? How will you do this? Okay, Rihanna says, look at the disclosure requirements of trade payables in the balance sheet and notes to accounts. And of course, when you say look at that, so that will be based on two things. Good, Prem says that will be based on Schedule 3 and accounting standard. Yes or no? Yeah. So as an auditor, you will ensure compliance of that in terms of Schedule 3, in terms of various requirements of accounting standards, whether that has been taken care of or not. Okay. Yeah. Clear? Now, these are some of the audit procedures we can say which will be performed in respect of trade payables. Now, other than trade payables, there is another item which is called as other current liabilities, or you can say other liabilities. Let me just call it as other liabilities because other liabilities once again can be current or non-current, and some part of those other liabilities can always be in current, can always be in non-current. Now, in this case, before we really move further on this, can you just give me some examples of these other current liabilities which may be there in the financial statements, plus what are going to be the audit procedures on those. Over to you. Now, what could be those other current liabilities, other non-current liabilities? Yes, some of the liabilities that you can think of quickly. Okay, so Prem says provision for tax. Rihanna says prepaid income. Okay, I think when you're talking about prepaid income, you're just talking about the deferred income, is it? Great. Almas says outstanding expenses means the expenses against which amount is payable. Then Rohan says interest on calls in advance. Sahil says interest payable. Yes, of course. Any other examples? Yeah, so there are a lot of items which can fall under this category. One is the outstanding expenses. Means expenses which are not yet paid. Now, what are those expenses? So we are talking about any expenditure which is other than purchase of goods or services, because that part will fall under trade payable. Yes or no? Yeah. So to a certain extent, we can also say salaries payable. Yes or no? Okay. Then of course, another example could be in respect of statutory dues. For example, TDS payable could be there. GST payable could be there. Yes or no? Yeah. Of course, these are some of the examples which could be there. Yeah, so salaries payable are there, outstanding expenses are there, statutory dues are there, TDS payable, GST payable. Some of these items are there. Then, further on this, various kinds of procedures one can think of. Okay, let's try to just discuss some of them one by one. See, when it comes to the outstanding expenses, so basically it's a liability which is in respect of expenditure incurred during the year. Yes or no? And certain part of that is outstanding. So if that is in respect of expenditure, so similar to what you will do in respect of trade payable, of course you will check the opening balance traced to previous year's financial statements, and the built up of this liability will be through the various expenses. So on a sample basis, some of those expenses you will verify. Yeah. And then on the closing balance, you will perform certain procedures which could be in respect of looking at the management process. Okay. Now, in terms of management process, you will check as to how these liabilities have been recorded, whether these liabilities have been completely recorded or not. Okay. Now, in respect of TDS payable, GST payable, once again, you'll check on a sample basis as to whether TDS has been appropriately deducted or not, GST whether that has been appropriately charged or not. And in respect of some of these statutory dues, you will always reconcile that with the tax records, with the GST records. Okay, so that's a cross check in a way. Because you are ensuring that something which is there in the books of accounts is matching with what is there in the portal also, whether it is about TDS liability, whether it is about the GST liability. Okay, now other than that, of course, some of the procedures that we have talked about in respect of trade payable will also arise in respect of other current liabilities. So now what we will do is we will flip through some of these audit procedures once again from the study material, and we'll just try to understand some of the things that we have already covered in terms of how to draft that. Okay. All right. So now, as regards both of these items, trade payable and other current liability, what do you do first? Control testing you'll do. Okay. Which of course is going to form part of the audit procedures at various places. Okay. So that's about the control testing, which could be in relation to purchases and which could be in relation to various other expenses. Okay. Yeah. So all of these controls, whether those are in place or not. So you look at the RCM, risk control metrics, means whether the controls are in place or not. Then of course you will do the control testing. Control testing will again be done on a sample basis to check whether the controls are operating in an effective manner or not. Okay, then as regards the trade payable. Now, another important procedure which could be there in respect of trade payable could be around its aging. Yes or no? Could be around its aging. Now, in terms of aging, we can say that if, let's suppose, there are trade payables which are outstanding for a significant period of time, means which are long outstanding for more than 6 months, more than 1 year, more than 2 years. So in such a case, what do you do? What do you do? Correct. So you'll of course review the aging, and in case the trade payables are not getting paid, so you'll ask the management, you'll make inquiries from the management as to what all things have been done in respect of that. Yeah, some of the things which have not been covered in respect of that. Okay, some of the things which may have been done in terms of obtaining the balance confirmations from other parties. For example, if there are any disputed balances, but those are still outstanding. So now what is the action plan of the management? Action plan means whether the management intends to make that payment or not, because now the management will have to explain this. What is their intent, whether they intend to pay this or not. If at all this will be paid or not by the management. Yeah, so some of these things are of course required to be looked at. Okay. Now, next, in respect of old outstanding, if let's suppose there are trade payables outstanding for more than 3 years. Okay. So of course you'll go inquire, you will also identify the reasons. If let's suppose you come across old outstanding, say more than 3 years, okay, and the management is also not having any clear answer. Many a times you'll see that the management doesn't have a clear answer. Okay, they may say that of course these are liabilities and we will be taken care of in some period of time. As of now, these amounts are under discussion with various parties, but you have not been able to get the proper explanation from the management. Now, in such a scenario, what do you think will be the course of action on your part? So how will you handle this? How will you manage this? Over to you. Over to you. How will you handle this? Yes, quickly. How will you handle this? How will you manage this? Yes, quickly. Huh? How do you handle this? How do you manage this? Tell me anything that comes to your mind. So what is going to be the audit procedure then? Prem, I'll come to your query. Okay, so let's think about it. So let's suppose if there are old balances which are not getting paid by the management. Payments are not taking place. So in such a case, what do? You'll have to understand. You'll have to look at whether these payments will eventually be made or not. Okay. And if, let's suppose, those are not getting paid, and these are long outstanding, 3 years, 4 years, 5 years, then of course you'll look at the write back. Means whether these liabilities should continue to be there in the books or not. Okay, whether these should be written back. Written back means you'll remove the liability from the books of accounts. So that's also one of the course of action which the management needs to evaluate, and which the auditor also needs to evaluate whether that has been done or not. Okay, and whether that path should be chosen or not. So this again becomes important on the part of the management as well as the auditor. Okay, now another procedure I think we have already talked about is the direct confirmation. So once again, I think at length we have discussed this. So moving further, which again needs to be done on a sample basis. So you can see that all of these pointers which you can see were all in relation to the confirmation procedure only. Okay, now next, because we are talking about purchases in a way in respect of trade payables, so a significant number of transactions in the company could take place with the related parties. Okay, so there could be a significant number of transactions which are taking place with the related parties. Now, when such a significant number of transactions are taking place with the related parties, we need to evaluate. We need to evaluate whether those transactions are those transactions have taken place at arm's length or not. Yes or no? Yeah, because when it comes to a transaction with a related party, what is the risk? The risk is whether the transaction was at arm's length or not. Yeah, that's the risk. Okay, so that is something which needs to be evaluated, whether that has taken place at arm's length or not. And of course, when it comes to the transactions with the related parties, particularly, they will require some sort of pre-approval. Okay, because in terms of that transaction to take place at a particular price, at a particular value, management must be having some mechanism which they need to evaluate, on the basis of which they will check whether these have taken place at arm's length or not. Okay, which is also about the authorization, whether that has been done or not. Okay, next. Then we can also look at some of the analytical procedures wherein the trend of purchases can be observed, trend of expenses can be observed. We'll discuss this more of, or you can say in further detail, when we'll move on to the P&L. Okay, but as around the purchases, of course, as to whether purchases are increasing or decreasing on a monthly basis, you will just evaluate as to what is the trend and the rationale behind the trend. Okay, that rationale again needs to be looked at, that needs to be understood. Some sort of variance analysis needs to be looked at. Now, variance analysis means as to how the purchases have been behaving year on year. Okay. All right, so I've received a couple of questions. So Prem is asking, sir, the controls that we discussed. Okay, the auditor, the control that the auditor needs to check, are those internal controls? Yes. See, when we talk about controls, so we are talking about controls which need to be put in place by the management, and that should be in relation to their various operations, various processes. Okay, and controls are always internal to the company. Okay, so whenever any aspect of control will be discussed, so that will always be internal controls, means controls in relation to that particular company. Sahil is asking, what is arm's length? See, arm's length, let's take an example to discuss this. Let's suppose, okay, let me just go to one working sheet. What is arm's length? Now, arm's length in a very simple terms, you can say, is about ensuring whether the transaction has taken place at fair value or not. For example, say there is a company A Limited. Okay. Now this company is transacting with two parties, B Limited. Now B Limited is unrelated to A. Okay. And it is also transacting with another company C Limited. Let's suppose C Limited is a subsidiary of A. Yeah. If you look at C Limited, it's a subsidiary of A Limited. Yeah. In this case, it may happen that in respect of sales, let's suppose A is selling to both the parties. Same goods are sold to B as well as C. But the price which is charged from B, let's suppose is at the rate rupees 100 per unit. Okay, which appears to be the fair value. Okay, so in the market, this is the rate at which this item will be sold. But it may happen that the price which is charged from C is only rupees 60 per unit. Okay. Now, in this case, idea is to check whether this transaction is taking place with C at arm's length or not. Now, it appears that because the price charged from C is significantly lower, of course, the margins could be different for different parties, but because this is significantly lower as compared to what is charged from B, yeah, so it may not be at arm's length. And there's also a reason which is attached to that. What is the reason? It's a subsidiary. Means it is related to A. Yeah, so the moment we say it is related to A risk gets attached. What is the risk? What is the risk? The risk is that the price charged is not fair. Okay, so this is what is need to be checked. That is what you call as arm's length. Arm's length means fair price. Clear on this? Yeah, Sahil, clear? Yeah. All right. So now moving further. Okay. So now cutoff, I think we have already discussed for the last five and first five. And it's not necessary that last five invoices or first five. So you should not think that by default, you'll always be looking at only five in number. It can always be first 5 days, last 5 days. It can always be first 10. So every time we need to check what is going to be the extent. So should you keep this extent only to five, last five and first five, or you need to increase that? That can always be done. That is something which the auditor needs to evaluate. Okay. Now, further, testing the purchases expenses on a sample basis we have discussed. Okay, then of course to check the underlying documents along with the purchase invoices, means whether that is getting traced to the gate inward entries or not. Means purchase invoice is there, but whether the goods were actually received physically or not. So how do you go check that? You look at the stores entry, gates entry, okay, wherein all of these records would have been maintained. Okay, then next, review the subsequent expenses vouchers. Now, once again, another very important procedure which is required to be performed is called as subsequent testing. And what is the objective of performing this procedure? See, the objective of performing this procedure is to ensure completeness. Now, let's try to understand as to how this subsequent testing is performed. Okay, so now in respect of subsequent testing, say if the audit of year 24-25 is performed, and I think we have discussed this procedure earlier also, but let's discuss this once again. And let's suppose audit has to get completed, say timeline is 31st of May 2025. So the auditor generally plans to review the expenses, okay, which have been booked subsequent to reporting date. Okay, subsequent to reporting date. That means for this period. Okay, for this period. Now, does it mean that it will have to be done up to the date the financials are required to be signed? Not necessarily. See, it will always be like auditor will draw a line. Okay, let's suppose auditor has taken a cutoff. So what's the cutoff? Let's suppose auditor believes that he will do this, say, up to 20th of May or say 15th of May, because he needs to also wind up the audit. Otherwise, it will keep going on, because then the auditor needs to conclude, he needs to get on to the reporting and some of these requirements as well. Yeah, so this cutoff will be drawn. So let's suppose this cutoff happens to be 20th of May 2025. Okay, so this is 20th May 2025. Okay, now in this case, considering this cutoff, what will the auditor do? Auditor will be testing the expenses. He will review the expense ledgers. Means he will scrutinize the expense ledgers or various other heads that he will perform the subsequent testing on. Why is this called the subsequent testing? Because he is looking at the period which is after the reporting date. And what is the objective in terms of review or in terms of checking during this period? To find out if there are any expenses, there are any transactions which have been booked during this period. Okay, which have been booked during this period, but which pertain to 24-25. Okay, so that's the objective. That's how it's required to be looked at. Yeah. So now once this is done, once this is looked at, that's how the auditor will approach this. That's how the auditor will be looking at this. And if let's suppose, say auditor comes across certain transactions, certain expenses which have been booked during this period, which actually pertain to this period, so he will move those expenses to the correct reporting period. Thereby he will ensure the completeness for the financial year 24-25. Okay, clear on the subsequent testing procedure? Yeah, everyone clear on the subsequent testing procedure? Yeah, particularly from the expense side, this is considered to be an important procedure because this helps in ensuring completeness. Yeah, I'm just hoping you're clear. Any questions, any doubts so far? Any questions, any doubts so far? Yes, quickly, anyone? Okay, Prem is clear. Very good. Any questions, any doubts if you have? No? All right. So let's move further. We are not yet done. So there are some more procedures on this. Then, as we discussed about the statutory dues, again considered to be a very important area. Okay, in terms of the statutory dues, what is it that the auditor will do? Auditor will check the liabilities, whether those liabilities have been paid on time or not. Okay, he will also reconcile some of these liabilities with the statutory records. Okay, TDS, GST, all of these with the statutory records. Okay, now it could be TDS, ESI, GST, PF. Okay, there could be various types of statutory liabilities. Okay, then further, in terms of the valuation, we have already looked at that for the valuation, aging will be checked, thereby the write back if required, that will be checked. Okay, then of course underlying documents will be checked to ensure the amount, whether the liabilities have been recorded at the correct amount or not. Okay, then in respect of disclosure requirements, we have already looked at that schedule 3 and the accounting standard requirements for the presentation and disclosure needs to be checked. But here there's one important disclosure requirement. Okay, particularly for trade payables, this is a very important requirement, and that is in respect of MSMED. I think you must be knowing about MSMED. MSMED is a disclosure in relation to micro, small, and medium sized enterprises. Means the trade payables, the parties, okay, the suppliers, if they happen to be micro enterprise, small enterprises, medium sized enterprises, for which a criteria is given. So there's a separate act, MSMED Act, which talks about this criteria. So if these parties are falling within this MSMED criteria, then certain disclosure requirements need to be made in the financial statements. If at all there are some dues to these MSME parties, then the interest needs to be recognized on the same. Okay, and the corresponding disclosures are also required to be made in the financial statements. So now in this case, once again, the procedure will be to ensure whether those disclosures, presentation requirements have been appropriately made in the financial statements or not. And of course, in addition to what's been done, okay, as around the disclosure as well as the presentation requirements, it will also be important to check whether the classification of all the trade payables into MSMED, means into MSME, and non-MSME has been appropriately done or not. Now this again you can say will be a part of process. Okay, so the process will have to be there in the company in respect of such classification, and the entity needs to ensure that such process is in place. Such process is taking care of the all of those requirements in the company. Okay, if at all it's found to be missing, if at all there's any problem in such process, that needs to be taken care of. Okay, yeah, clear on this? All right, then of course I think in terms of the disclosure requirements, MSME we have already discussed. Then the disclosure requirements for trade payable has to be as per schedule 3. Now recently there was also a disclosure requirement which got attached, wherein the aging of the trade payables is required to be disclosed in the financial statements. Okay, so if you look at the aging, it talks about MSME, others, if there are disputed MSMEs, disputed dues in respect of others, okay, and in terms of their aging, what are less than 1 year, what are due for more than 1 year, less than 2 years, 2 to 3 years, more than 3 years. So this is a aging bucket, and this is the standardized version, okay, which needs to be filled and disclosed in the financial statements. Okay, and of course, on this aging, the audit procedure will have to be performed. Means whether this aging is correct or not. So how do you go and check the aging? You'll look at some of the samples. You'll look at the invoice date. You'll look at the due date, whether the aging is appropriately capturing the due dates or not. Okay, because that will always be based on the due dates. Correct? Okay. Then in respect of other current liabilities, now for different types of liabilities, there could be different types of disclosure requirements. But of course, some of them are given here, which need to be taken care of by the auditor. Okay. All right. So with this, we are through with trade payables as well as other current liabilities. Now the next head that we are going to cover will be about loans and advances, other current assets. But before we move on to that, any questions, any doubts that you may have? Over to you. Any questions, any doubts that you may have? Yes, quickly. Any questions? No questions? Prem is clear. What about others? Quickly, any questions, any doubts? If you have, please let me know. No? All right. So I think Vishal is also clear. Very good. So let's move on to the next item, that is about loans and advances. And other current assets. Okay. So can you first of all tell me what will be included in loans and advances? What will you have in respect of loans and advances? And what are some of the items which will be there in other current assets for both of them? Can you give me some examples as to what will be included under these two heads? Over to you. Okay, so I think Dhanush has a query. Dhanush, I'll come to your query. Let's quickly discuss some of the items. Okay, so I think one is this. Sahil says loan given to various parties. Rihanna says long-term bank loans. No, so if you talk about long-term bank loans, that's a liability, that's a borrowing. We are talking about asset side now. Loans given. Okay, advances given. Sahil is saying advance interest. No, so advance interest, again, what is the nature here? What do you mean by advance interest? Okay, Sunil is saying advance income like advance rent. Are you talking about prepaid rent? If you're talking about prepaid rent, then of course it can be an example of other current assets. Prem says loans which are given to outsiders, directors, various related parties. Good. Ariana says short-term advances. Yes, so these could be short-term or long-term, but advances means advances given to various parties. Almaz says prepaid expenses. Yes. Income receivable. Yes. So that will also be you can say other current asset for you. Sahil says advance interest received. See, if you have received the interest in advance, so that will not be an asset for you, isn't it? Just think about it. Yeah. So if you receive interest in advance, that will become a liability for you. And we are talking about the asset side. Okay. Clear? Yeah. All right. So now I can see one query before we get on to these audit procedures. Okay. I could see one query from Dhanush. So Dhanush is asking, sir, in trade payables, if the book value that recorded book value at which the trade payables are recorded is less and what the company needs to pay might be higher, how the auditor reacts. Okay, so I think you're talking about a situation wherein the trade payables are not recorded at the correct amount. Yes or no? Yeah. So you are saying trade payables are recorded at rupees 100. Actually, amount payable is 110. So then, of course, you'll have to evaluate that. This is an error. Okay, so you'll ask the management to correct it. Okay. So that's the first course of action. And you'll also evaluate the materiality. If the management says, no, we don't want to do this, so you'll look at the materiality as to how significant is that. Okay, so that's how you'll have to consider this. Okay, so that's how you'll have to consider this. Fine. Okay, so then I think some of the other examples I've received, which is okay. Yeah. All right, so now let's talk about audit procedures in relation to loans and advances. See, over loans and advances, we are talking about asset side, means we are talking about advances given, loans given. Okay, now that will again depend on the purposes for which the loans and advances are given. Generally, for the loans and advances, you will look at two things. These are given to related parties, one, or to others. Okay, so this is the thing you will check. Means whether these are given to related parties or to others. Okay, now in this case, if let's suppose these are given to related parties, then in such a case, the procedure or the risk that you need to evaluate is going to be what? Arm's length. Okay. And otherwise, underlying documents. See, generally for loans advances, what are going to be the underlying documents? Agreements. Now, agreements to be checked will not be required only for other parties. That will also be required for related parties. But for related parties, one aspect which gets added or over which we need to be careful happens to be the arm's length. Okay, so that aspect needs to be added, or you can say which is required to be looked at. Further, if we are talking about loans or advances given, then there must be some repayment schedule. Yes or no? If the loans are given, advances are given, so there must be some mechanism of repayment. Okay, as to how these are going to come back. So whether the collections are getting made or not. Okay, further, whether these are interest bearing or not. Okay, there again, some of the requirements of Caro get added. Okay, so Caro requires you to take care certain aspects around it. Means the purposes for which the loans advances are given. Whether those purposes are anything which are against the interest of the company or not. Okay, whether these are given for long-term purposes or short-term purposes. Then of course the classification requirement, whether these are long-term or short-term, and whether these have been appropriately classified as long-term or short-term. Okay, so all of these aspects are required to be looked at. Further, whenever such loans and advances are given, see, until unless it's the nature of the business of the company to give loans and advances, okay, which will happen in case of NBFCs, for example, banks, or you can say the companies which are in the nature of financial business. Otherwise, that will not be the nature of business. And in either of the cases, okay, so you need to understand whether this is permissible or not. So there are certain restrictions, plus there are certain requirements which are there as per various regulations, particularly Companies Act, okay, which needs the company to ensure whether those loans advances are given as per the requirements of those regulations, those act or not. Okay, so now all of those requirements, so you can say regulatory requirements, need to be checked. Yeah, so those regulatory requirements need to be checked. Further, over and above these regulatory requirements, another aspect which is required to be checked will be in respect of the transactions which are taking place. Okay, whether the company is into a significant number of such types of transactions or these are only few. Okay, and of course, in some of the cases, loans and advances may have been given, but the agreements around that are not available. Okay, for example, within the group companies, it's commonly seen, it's commonly observed that the advances are given, okay, but the purpose is not specified, or many times the executed. Okay, there's no repayment plan in respect of those advances. So all of those aspects are required to be looked at. Why? Because auditor needs to evaluate as to whether the objective around the loans advances is as per the requirements which are specified in the memorandum, or the permissible limits, you can say, in very simple terms, for that particular company or not. Okay, yeah, clear on this? Yeah, any questions so far, any doubts so far? So this was about loans and advances. We'll move on to the other current assets after this, but any questions, any doubts if you have before that, please let me know. Any questions, any doubts? Yes, no questions? Sure. All right, so what we can do is we can now take a break. Okay, after the break we will continue with this. Okay, yeah, fast, we can take a break now. Fast, you are there, we can take a break now. Yeah, let's do it 10 to 15 minutes. Huh? All right. Okay. Yeah. So let's continue. Yeah. I can see this query from Prem. He is asking, sir, what is Caro? So Caro, you can say, is one of the requirements of the Companies Act in relation to the audit report. For certain specified categories of companies, auditor is required to report upon certain matters. One, audit report which you would have seen, okay, or maybe in the due course of time you will see, okay, that is also a part of your course curriculum, wherein the auditor is required to express an opinion, that is called as main audit report. Along with that, for some specific companies, another report is required to be issued, in which case some specified procedures are given. You can say it's a kind of checklist. So auditor needs to respond on that, whether all of those procedures have been covered by the auditor or not. Okay, so that's the thing which is required to be taken care of by the auditor. Clear? Yeah. Okay, so now let's continue on this. So now I think we have discussed some of the procedures around loans advances. Okay, and of course we understand there's another component of other current assets. So let's look at these audit procedures in the study. Yeah. One, for the existence. Here again, what will you do? Because these are advances, loans given to third parties. So direct confirmations will have to be rolled out. So that's one of the procedures you'll perform. Now, as around this direct confirmation procedure, we have discussed this quite a lot. So it's not necessarily required to be repeated. But when it comes to the related parties particularly, okay, so related parties will be covered in entirety. So of course, a sample will be considered. Generally, a company may not be having a lot of loans and advances except for companies which are in financial business. But irrespective of the number of loans advances which are there, those which are given to the related parties, they need to be ensured that those are covered by the company. Okay, further, as regards the documentation that the auditor would want to review, that will be in relation to the agreements, because over here there are no invoices, there are agreements with the third parties, so those are required to be looked at. And in terms of those agreements, those transactions, okay, those advances which have been given, whether those are authorized or not. One, whether the company is authorized to give those advances or not. So where do you get to see that from? Memorandum of association, articles of association from a company. Okay, so these are the documents which will specify whether the company can give these or not. Okay, in addition, the auditor should confirm whether these are sort of approved by the board of directors, because there must be some mechanism internally wherein the approval has to be there. Only then the advances can be given, only then the loans can be given. So that is also required to be looked at, that is also required to be evaluated. Okay, yeah. Then next, inspect the minutes of meeting of board of directors to confirm if all material loans advances were approved by the board of directors. So I think we have already talked about it. Then in respect of loans advances which are given, here again, similar to what you'll do, like in case of borrowings, sometimes these loans advances could be secured, sometimes these may not be secured. So if there is any security against that, so that the auditor will get to know about it, of course, from the documentation. And once the documentation is looked at, okay, so there again, the auditor needs to evaluate that, review that. Okay. Next, in relation to related party loans advances, review whether these are properly authorized or not. And of course, in this case, an aspect of arm's length becomes very important. Okay, so that aspect becomes very important. Yeah. Then, in relation to other current assets, now what could be the other current assets? Prepaid expenses could be there. Here again, there could be some statutory balances, for example, advance tax, GST input credit. So, how will you verify them? Of course, here again, you will look at the reconciliation in terms of what are the advances, what are the GST input credit which are appearing in the portals of those particular statutory authority, and whether that is whether the amount which is recorded in the books of accounts is reconciling with those records or not. Again, very important. Okay. Then, in this case, now because the loans advances have been given, so sometimes what may happen is that some of the loans advances could be again outstanding, and they may remain outstanding for a significant amount of time. So in this case, aging analysis becomes very important. And what do you mean by aging analysis? Means the aging report of these loans advances will have to be reviewed. And that aging report needs to be compared with the outstanding balances. And it also needs to be evaluated, particularly in respect of long outstanding loans advances, as to what are their chances of recovery. Okay, because we are talking about an asset side, so the management's expectation of that recovery needs to be evaluated. Why? Because if those are doubtful, the chances of recovery of that is not so significant, or you can say is lower than the requirement to create a provision for those needs to be looked at. Okay, yeah, so that needs to be looked at. So that again becomes very important on the part of the management. Okay, then in this case, once the analysis is done in respect of aging, in respect of these securities, in respect of old outstanding, if let's suppose some of the advances are not recoverable, so what is it that the management will do? Management will have to get onto that assessment as to whether those need to be written off or not. Yeah, so that again becomes important on the part of the management. Okay, then next, in respect of disclosure requirements, presentation requirements, which is a standard procedure. I think we have discussed this quite a lot. So this will also get repeated in terms of loans advances, whether these are long term or short term, whether these are secured or unsecured. And here again, the classification of some of them becoming doubtful, and in respect of whether these are secured or unsecured, whether those are good or doubtful, allowances for them, whether that has been created or not. If that has been created, an appropriate disclosure for that needs to be included. Okay, if at all there are some loans advances which are given to directors, some of the related parties which are specified, those are also required to be disclosed as per the requirements of Schedule 3. Okay. Similarly, the disclosure requirements for short-term loans advances needs to be looked at, very much in line with what we have under long-term loans and advances. Okay. So this is it that we had on long-term loans and advances. Now we will move on to another very important and quite interesting item, that is provisions and contingent liabilities. Okay. But before that, let's discuss any questions, any doubts if you have. Okay, so Moini is asking, sir, in the exam questions will be asked related to the balance sheet. So it's not about only about the balance sheet, P&L, any of these areas could be there. See, it's like we are moving sequentially. So first of all, we are picking up items of balance sheet, then eventually we'll also get on to the items of P&L. So any of those could be there. Okay, yeah, so any of those could be there. And generally, what you will get is you will get a situation, okay, wherein you will have to assess that situation in terms of the assertions which are linked to that. How would you deal with that? Yeah, so it's going to be more of sort of case based scenario, something that we have been discussing. Yeah, okay, any other questions if you have? Any questions, any doubts? Yes, over to you. Then we'll move on to the next head, provisions and contingent liabilities. No further questions? All right, so let's move on to the next item, provisions and contingent liabilities. Okay, so provisions and contingent liabilities, right? Now, as around provisions and contingent liabilities, please understand that we are looking at two items now. Yeah, provisions is a different item. Contingent liability or contingent liabilities is again a different item. Now, provision is something which is recognized in the financial statements. Yes or no? Yeah. So this is something which you will see recognized in the financial statements. So an accounting entry for the same will be passed. So it will be recognized, measured in the financial statements, and it will also be presented in the balance sheet. Okay, corresponding impact will also be there in the P&L. But contingent liability is not recognized. Yes or no? It is only a disclosure. Yeah, it is only a disclosure. So, what do you mean by disclosure? Disclosure means it will not be there in the balance sheet, it will not be there in the P&L. Yeah, you will not be passing any accounting entry for the same. If you look at the perspective of the management, it will only be, you can say, a disclosure which will appear in the notes to accounts. Yeah, so it's only a disclosure. And where do you get to see this? In the notes to accounts. It's only a disclosure. Okay, yeah. So I'm just hoping that you have understood the difference between these two. So this is more of the accounting that we have discussed, or you can say more of uh, the financial statements that we have discussed as to how they will appear in the financial statements, how you will get to see them in the financial statements. Yes or no? Yeah. Now, let's also try to understand their accounting requirement in slight more detail, because that is how we will also be able to design the audit procedure. So now, can you explain, or can somebody help me understand what will be the basis of recognition of a provision and when do you disclose anything as a contingent liability? So both of them, what is the criteria for recording them in the financial statements? Great. Sahil says AS29. Very good. So that's the accounting standard. But what is the requirement of accounting standard? Yeah. So what is the requirement of this accounting standard on the basis of which provision will be recognized or a disclosure of contingent liability will be given? Prem says it has to be passed by the board of directors. Okay. What about others? Yes. What about others? Quickly. What will be the basis of recording of these items? Over to you. What will be the basis of recording of these items? Anyone? Any thoughts? No? Okay, so I think it becomes all the more important to understand that first, because only then you will be able to audit this. Yes or no? Because till the time you don't understand, how will you audit that? Correct? Yeah, so that's the thing we have discussed. Now, for this to be audited, let's get on to its accounting requirement. If let's suppose there is any transaction, any event, okay, for which there is a good probability, or you can say it's probable, means there are more chances that it may result in some outflow of resources. For example, say there is a tax demand. Okay, so there's a tax demand in case of a company, and there are higher chances that if at all company gets into the litigation, so company will lose the case. Yeah, so there are good chances if the company goes into litigation, company will lose the case. In such a case, what do you do? In such a case, what do you do? In such a case, when there is a tax demand and the company is probable, means company is of the analysis that there are good chances that this demand is going to fall on the company. So company will recognize this. Yeah. It may happen that the timing of this outflow or the exact amount of this liability may not be assessed. Okay, company may not really know as to what is going to be the exact amount which is involved in that, or in terms of the timing. Why? Because it may be under litigation. But because it's probable, so that's why it's required to be recorded. Priyanshi says provisions are also required to protect the company from sudden losses. For example, provision for doubtful debts. Yes, that could also be one of the example of provisions. Okay, but there again, one aspect that you need to consider is that when you create a provision for doubtful debts, so what is the basis? When the company believes, okay, when the company is probable, when the company sees that there's a higher chance, okay, there's a good chance that the money will not be recovered. So that is when the company will create a provision. Company will recognize a provision. Yes or no? Yeah. Okay, now let's suppose there is a tax demand against the company. Okay, now in respect of this tax demand which is there against the company is not sure. If let's suppose company has got into litigation which the company plans to do, company is not sure as to whether the company will be able to win the case or lose the case. Okay, so company is unsure about that. Yeah. So in this case, when the company is not clear, when the company is not sure as regards the outcome of that litigation, means company doesn't see a good chance of losing the case. If there was a good chance of losing the case, company would have recognized that amount as a provision. At the same time, company is not sure that company is going to win. Okay, so it's like company is stuck. It's a 50-50 situation. Okay, so there is no clarity as of now on the basis of situation which is there. Yeah, on the basis of current circumstances, there's no clarity. There's no clarity. Yeah. So in such a case, the question arises, what should the company do? Okay, what should the company do in such a case? So company is saying that it's 50-50. Yeah. So in such a case, company will give a disclosure in respect of that item or event or transaction. And what do you call that disclosure as? Contingent liability. Means liability is there, but that is contingent. That is contingent upon occurrence of something which is not known at this point of time. Okay, over which there is no clarity at this point of time. Yeah. So that's the thing which you have in case of contingent liability. Okay. Yeah. So this is something which is required to be looked at in case of contingent liability. Clear? So I'm just hoping that you're clear on the accounting requirements of both of these items, provisions as well as contingent liabilities. Any questions on that? Any questions on that? Tell me quickly. Any questions on this? No? Everyone clear on this? Yeah? All right. So now moving further. Now what we will do is for both of these items, for provisions, contingent liabilities, what we will do is we will pick up the audit procedures. Okay, we'll pick up the audit procedures in relation to both of them. So now, if you look at the assertion related to existence, and if you look at the assertion related to completeness, so what do you do? First, in respect of the provisions which are recognized in the financial statements, you'll obtain a list, or you can say ledger you'll obtain. Yeah. And you'll check as to whether that is matching with the details. Company must have prepared some working for all of those provisions. Yeah, so that will be matched if at all you're in the workings with the books of accounts. Okay, so that is one. Next, inspect the underlying item agreements, like agreement with the customers to assess warranty commitments, any legal and other claims on the entity. Okay. Yeah. Now in this case, when you are looking at the underlying agreements, so what is the objective? Objective is to check the valuation, accuracy, if you look at it from P&L perspective, completeness. Why? Let's suppose a provision for warranty has been created. Okay, let's suppose a provision for warranty has been created. Now, how will you go audit that? You will obtain the working. So management must have prepared some working for that provision for warranty. Yes or no? Now, in respect of working for that provision for warranty, what is going to be the next step? Next step will be to look at as to how that amount has been derived. Okay, and in terms of the agreements which are there, in terms of the provision for warranty which has been created, what is the arrangement, what are the terms of sale? Because if let's suppose when the goods are sold, so there must be some terms that the customer can claim this warranty, or customer will given a warranty period of say 1 year, 2 years, 3 years, and what all things are going to get covered in that warranty. So that is how management will assess as to what is the cost which may arise on the part of the company in the future years. Yes. And up to what period? So that will become the basis for creation of such provisions. Yes or no? Yeah. So that will become the basis. Now, in respect of such basis, in respect of such provisions, which the management plans to do, which the entity gets to do. So what are those amounts? Okay. And what is the basis of creating that? So in this case, you'll not see any invoices. Yes or no? So what are going to be the underlying documents? So now that will again vary from the item to item. In case of provision for warranty, like we discussed, you'll look at the arrangement with the customer. So you may be looking at the sales agreement to understand this. Similarly, if you are talking about any other provision, so there again you need to find out what is the nature of that provision. How will you get to know about that nature, and what should be the amount that needs to be recorded over there? That again you'll get to know from the underlying documents. Okay, so again we can say underlying workings, underlying documents for different types of provisions are required to be looked at. They need to be verified, and it needs to be ensured whether those are recorded completely and the amount is correct or not. Okay, yeah. Wherever required, obtain experts report, calculation and underlying working for the provision amount. Yeah, so the workings which are obtained. So then you will have to check the calculation, whether the calculation is correct or not. Okay, and you also need to check whether the amount which has been recorded, of course calculation is arithmetical exercise, you can say it's more of clerical, but you also need to understand whether the company has recorded the correct amount or not. Yeah, sometimes these calculations, particularly the provision for warranty, could be quite complex in nature. Okay, sometimes management may have involved third party experts. Okay, some valuers may have been engaged. Okay, again in some of the companies it's done. Why? Because the calculation or the basis of calculation, both of them could be complex. So in such a case, what will you do? You also need to then check that. Number one. Further, you also need to perform the procedures related to working of the management's expert. Remember, we discussed that whenever the management will involve an expert, so auditor needs to review the work of that expert. And before getting on to the review of work of that expert, what is it that the auditor will do? First, auditor will have to evaluate the competence of that expert. Okay, whether that expert is really competent to do that job or not. Okay, so that is one. Once that is checked, means the right person is there who is calculating that, then the auditor needs to look at the assumptions, okay, the basis of that workings, for which the auditor may have to get into the discussions with that expert also. Okay, so that sort of discussion is also required to be done. Yeah. Now, sometimes here again, it may happen that this calculation or some of these provisioning which have been calculated are quite complex, and auditor may also not be competent to do that. So can you tell me, in such a case, what should the auditor do? Sometimes auditor may also not be competent to do that. So in such a case, what should the auditor do? Tell me, over to you. What should the auditor do in such a case? Rihanna says, obtain the opinion of the expert. No, so opinion of the expert, what does it mean? Means he will go consult that expert, or what is the meaning of expert's opinion? Prem says, auditor may have to hire his own expert. Very good. Yeah. So now, whenever the management's expert is involved, so of course, auditor will review his work. Auditor will review the work of management expert. But at times, auditor may also consider whether there is a need to involve his own expert or not. Okay, yeah. So that is again something which is important, which is required to be looked at. Clear? Yeah. Now, in case of this work of an expert, as we discussed, some of the procedures will be to evaluate the competence capabilities of that expert, whether the expert is employed by the entity or is third party, whether the expert is independent of the entity, auditor's previous experience of work of that expert, if at all it's there, knowledge of the expert, his qualification, okay, obtain an understanding of the work of that expert, means what is it he has done. So auditor will also look at his working, some of the assumptions, okay, methods he may have considered, yeah, relevance and reasonableness of the findings or the conclusions of that expert, means his entire report is then required to be obtained. And if at all there is a need, involvement of the expert of the auditor is also required to be done. Okay, then next aspect is about the presentation and disclosure requirements. Yes or no? Presentation and disclosure requirements. So here again, if you look at the presentation and disclosure requirements, so what is it that the auditor will do? So auditor will once again look at that criteria of Schedule 3. Yes or no? Schedule 3 criteria. Okay, provision segregated into one, current and non-current, means long-term provisions, short-term provisions. Okay, so one, this will have to be looked at. Okay, if at all there is a provision for employee benefits, what is there for others? Okay, that is required to be looked at. Yeah, contingent liabilities, next area. In terms of the contingent liabilities, it's a disclosure in itself. Yeah, so contingent liability is only required to be disclosed. But again, this disclosure criteria or this format comes from Schedule 3. So that once again, auditor will have to ensure that whether it is in line with those requirements of Schedule 3 or not. Means contingent liabilities shall be classified as claims against the company not acknowledged as debt, if at all there are some guarantees, other money for which the company is contingently liable. Yeah, if at all there are any commitments, that shall be classified as estimated amount of contracts remaining to be executed on capital account and not provided for, uncalled liability on shares and other investments partly paid, other commitments. Okay, yeah. Then, in relation to provision, now there could be different types of provisions in the financial statements. So, an entity shall disclose complete movement of the provision. Now, what do you mean by movement of the provision? So, movement would mean, of course, the opening balance, closing balance, and any additions or deletions which may have taken place during the year. Okay, so any additional provisions made during the period, amounts which are utilized, which have resulted in the deletions. Okay, if at all some provisions were created but which were not actualized and which have to be reversed, again it talks about the deletion. So this is called as a movement. So in respect of provisions, there will be a movement which will have to be disclosed, or you can say presented in the financial statements. So opening balance, additions, deletions, and of course the closing balance. But addition, deletions will be in the form of additional provisions made and amounts utilized or reversed during the year. So this is how it's required to be done. Okay, further, an entity shall disclose the following for each class of provision. Now, what is that? A brief description of the nature of obligation and expected timing of any resulting outflows of economic benefits. An indication of uncertainties about the time. Okay, so this is about some of the disclosure requirements. Yeah, clear? Then some of the things which are in relation to some of the ratios, okay, which are required to be included in the financial statements, which may have some sort of analysis. Those are also required to be captured. Yeah. So this is it that we had on the contingent liabilities and the provisions in terms of their audit procedures. Any questions, any doubts that you may have, please let me know. Yes, over to you. Any questions, any doubts that you may have, please let me know. Okay. No questions? Very good. So let's look at one example. Okay, so I'm just trying to create a case scenario. So you need to understand this and accordingly you need to answer this. Let's suppose during the year, there is a provision in the financial statements. Yeah, let's suppose the outstanding balance of provision is rupees 5 crore. Okay, now this provision, let's assume this is for warrant. And the basis of creation of this provision is again the terms which are there with the customers on the basis of the sales agreements. On the basis of the sales agreements. Further, in terms of this provision, auditor needs to evaluate certain aspects in terms of the working, etc. So during the year, what the auditor has done is, auditor has reviewed the workings. So workings were prepared on an Excel sheet. So auditor reviewed the workings. Okay, so that is one. Second, auditor has also reviewed the underlying documents. Okay, I'm using the term review, so you can say it's verified, examined, checked. Okay, he reviewed the underlying documents. Okay, whatever were the relevant documents, he reviewed that. Supporting documents, etc. He reviewed that. Now, in this case, okay, let's go one by one. Okay, so for this first procedure which the auditor has performed, can you tell me which assertion has got covered? Okay, which assertion has been taken care of in this case? So if you look at the first procedure, which assertion has been taken care of by reviewing the workings? Over to you. So which assertion you think has been covered by the auditor, has been taken care of? Over to you, quickly. Prem says valuation. Okay, what about others? Valuation, what about others? Quickly, yeah. So you need to just think about the assertion which is getting tested by this audit procedure. So if you go check the workings, okay, review that, what is it that you will be able to capture? Priyanshi says completeness and valuation. Rihanna says existence and valuation. Anyone else? Okay, so let's try to understand. See, when you look at the workings, so of course, through the workings, you are trying to get a comfort on the amount. There's no doubt about it. So valuation should definitely be one of the assertion here. Okay. Now, that should definitely be one of the assertion here. Next, by looking at the workings, okay, so if you are getting that complete working, which you are checking, you'll also try to ensure that every type of provision, or you can say provisions in respect of all the agreements or all the customers have got included in this working. Because why would a provision be created in respect of warranty? That would of course be in respect of the customers. Okay, that would of course be in respect of the customers. Yes or no? Yeah. So now, if this working includes all the customers, then the auditor will be able to ensure that no party has been left out for which the provision should have been created. Okay, so that is about ensuring completeness. Further, when all the parties have been captured and their amount is also appropriately captured, so the auditor will be able to get on to the completeness. Yes or no? So therefore, through the workings, another assertion that is about completeness also gets covered. Correct? Yeah, so completeness again becomes important. Any other assertion that you think may get covered with this? Now, what could be the other one? Cutoff. Now, if you look at the workings, cutoff may not be completely captured. Why? Because if you are looking at the workings for the current year, okay, that will not be good enough. So if you include in the working some part of the next year, so then of course cutoff will be there. So cutoff, therefore, we should not consider here. Existence, once again, may not be the right thing to be considered here. Obligation, of course, that can arise. Yeah, but for that, some underlying documents need to be looked at. Okay, and of course, disclosure should not be the relevant one. Yeah, so we can say these two will become relevant in the context of this audit procedure. Yes or no? Now, let's move on to this audit procedure number 2. Can you tell me which assertion will get covered through this second procedure? So when you review the underlying documents, what are the assertions which are getting covered? Over to you. Tell me quickly. What are the assertions which are getting covered through this? Over to you quickly. Okay, so Priyanshi says rights and obligations. Prem says existence, obligation. Okay. Then I think Rihanna is saying valuation, existence, completeness. All right, so let's try to understand this one also. See, when you are looking at the underlying documents, so that will of course help you in terms of rights and obligations. Yes or no? Yeah. Okay. And valuation will also be the relevant one, no doubt, because through the agreement you will get to know the amount. In fact, even if you review the workings, you'll have to look at the underlying documents. Yes or no? Yeah. So valuation will of course be there. Other than valuation, rights and obligation should of course be there. Okay, so this should of course be there. Correct. Third, can you also look at the existence? Yes, to a certain extent we can say if you are looking at the documents, so existence to a certain extent is also getting checked. Correct. Cutoff may not be the correct one over here. Completeness, again, just by looking at some of the documents on a sample basis, you can't do that. Presentation and disclosure, once again, may not be the right thing to be considered here. Correct? Clear on this? Yeah. Now, similar to this, let's talk about a contingent liability. So in case of a contingent liability, company had given a disclosure. The company had given a disclosure. Now the disclosure talked about briefly this contingent liability. So in the disclosure, it was mentioned income tax matters. And let's suppose it was specified financial year or assessment year 22-23. Let's suppose this much part was specified. Okay, so that's in relation to income tax matters. Yeah. Now auditor is not really satisfied in terms of the disclosure which is given for some reasons. And he has a question mark in terms of this particular disclosure which is given. So can you tell me that in this case, which assertion is a problem if you look at it from audit's perspective, auditor has performed the procedures, but which assertion you think is impacted in the financial statements? Over to you. In this case, which assertion will impact? Priyanshi, I'll come to your query. Which assertion will impact which assertion will get impacted? Prem says disclosure. So let's try to understand this. See, there is no doubt that disclosure could be one. Okay, there's no doubt. Another one could be the valuation. Okay, because it's not only about the description which is a problem for the auditor. It may also be the amount. Okay, we don't know. Yeah, so that's why one assertion which could be impacted because of this observation of the auditor, we may say, is the disclosure. Another assertion which may be impacted due to this, we may say, is the valuation. Plus another observation which may be impacted due to this could be the completeness. Completeness means whether all the contingent liabilities which are required to be captured have been captured or not. Okay, so that could also be one of the challenges involved here. Okay, which need to be looked at by the auditor. Yeah, of course, you can also bring in cutoff. Yeah, but cutoff is not really linked to this. We are challenging this in a way on an overall basis, but these three appear to be the more appropriate one. Okay, now coming back to the question of Priyanshi. Okay, so Priyanshi wants to understand that, sir, when you are reviewing the underlying documents as an auditor. Okay, so if the auditor reviews the underlying documents, how will the auditor be able to get onto the valuation? Because documents will only show the legality. Documents will not help the auditor understand the provision in terms of the amount. So let's understand. Let's understand this with the help of an example. Okay. Say company has sold goods during the year. Say in 24-25, some goods have been sold by the company during the year. And company has a clause in the sales agreement. What is the clause? That the customer can come to the company over a period of next 3 years. Okay, over a period of next 3 years, customer can come and can make good that sort of any repair, if at all is required, or if there is any defect in the good. So the customer can come and the company will repair that. Okay, now, till the time auditor doesn't look at the document, will he be able to understand as to whether this provision should be created for year 1, year 2, or year 3? Tell me. Till the time auditor doesn't look at the document. So you may be thinking, but the management may let him know. But then where is the supporting document? So tell me. So till the time auditor doesn't review the document, will he be able to understand that whether the provision should be created for year 1 or 2 or 3? Tell me. Tell me quickly. Priyanshi, please confirm. Priyanshi says no. Now, if let's suppose auditor doesn't look at the document, and management creates a provision only for year one. Okay, management, let's suppose, ignores year two and year three. Whether intentional or unintentional, we are not getting into that. Let's suppose that has been ignored by the management. Okay, in this case, do you think the amount will be appropriately recorded? Do you think amount will be appropriately recorded? Priyanshi says no. Prem says supported document is needed as an audit evidence. Now, if let's suppose auditor will look at the agreement or the document, so he will say that why did you create this only for year one? Why has this not been created for year two, year three? So will this not have an impact on the amount of provision? Tell me, Priyanshi. Will this not have an impact on the amount of provision? Tell me. Will this not have any impact on the amount of provision? Tell me quickly. Tell me, what do you think? And everyone, please confirm. Will this not have an impact on the amount of provision? Over to you quickly, please confirm. What are your thoughts? What do you think? Will this have some impact on the amount of the provision or not? I'm just hoping everyone is around. Priyanshi, others, please confirm. Tell me quickly. Yeah, Sunil says yes. Prem says yes. Okay, so that's why we are saying that for checking the valuation, for checking the amount at which this transaction provision has been recorded, we also need to review the underlying document. Understood? Yeah. So underlying document will always have an impact on the valuation. Or you can say this valuation assertion will always be getting covered through the underlying document. Okay. Yeah. So that will always apply to that. Clear on this? Yeah. Everyone clear? So I think with this, we are through in terms of the balance sheet captions. And what we can do now is we can just look at your questions, doubts first. Prem is asking, can you please explain Benami property and struck off company in page 5.90? See, Benami property is like when the property is held in the name of somebody else. That is what is called as Benami property. Let's suppose A has a property. Okay, A has a property, but instead of purchasing in his own name, A got this property purchased, say, in the name of B. Yeah. So actually, this owner is A. Why? Because he got this purchased in the name of B. So that is what you call as Benami property. Clear? Struck off company means sometimes what may happen is that due to some of the non-compliances, say there is a company ABC Private Limited. Okay. Now, let's suppose due to some non-compliances, its name is removed from the registrar of companies. So every company's name is registered with the registrar of companies. But due to some non-compliances, their names may be removed. You can say it's a sort of deregistration, which is also called as struck off. So that is what you call as struck off companies. Okay, clear? Yeah. So Priyanshi is saying, okay, so the valuation as per the documents or not, and that's why it is also, that's why valuation is also considered. Yes, that's correct. Okay, and I think Prem is also clear on this. All right, so then I think though the time is not much, but still what we can do is we can just pick up this next item. Okay, maybe spend some few minutes on this in terms of what is required to be done here, what are going to be the audit procedures over here. Though we are going to cover this in more detail in the next session only. In fact, in the next session, or you can say our next session is devoted to the P&L items. Okay, to a certain extent, we have already covered some of the P&L items with the balance sheet items, but some part we are going to cover again. Okay, and some part that we have not covered, we are going to cover in the next session. Okay, so that's the plan, in fact, for the next session. Now, as regards the P&L, one can say that one of the most important item, in fact, the most important item in the P&L happens to be what? Revenue. Yes or no? Yeah. Even if we talk about the financial statements of the company, okay? So not only the P&L, even if we talk about the financial statements of the company, one of the most important items in the financial statements of the company happens to be the revenue. And that is why it is considered as a very, very important area as far as audit of financial statements are concerned. Now, in this case, when it comes to the audit of financial statements, revenue is one area which is considered to be a significant risk area. Okay. Generally, for various captions of the financial statements, what will you do? You will assess whether there is any significant risk involved in that particular area or not. Okay, generally that's the thing you'll do. Yeah, but revenue is one area which is considered to be a presumed significant risk area. Means in case of revenue, significant risk is presumed. Okay, so it's presumed. So in this case, in case of no entity, one can say that revenue is not a significant risk area. Understood? Further, there is another type of risk which we evaluate in respect of audit, in respect of various financial statements, and that is called as fraud risk. Means whether there is a risk of fraud or not. Okay, this again is required to be assessed in respect of various areas. But in case of revenue, once again, for revenue, this fraud risk is presumed. Okay, yeah. So you can now very well understand that revenue is of such a high importance. It's a significant risk area as far as audit of financial statements is concerned. So that's why a significant time, significant effort of the audit team, including the senior members of the audit team, is devoted on what? Revenue, or you can say the audit of revenue. And that's why there are significant procedures which are required to be performed in relation to revenue. Okay. So idea was to just give you a perspective in terms of the risk assessment and all, and which of course, as we discussed, is sort of presumed. Okay, it's considered as if it's in place. Okay, that is what is required to be looked at. Right? So this is something which we are going to cover in greater detail in the next session. Yeah. So now what we can do is, before we conclude, any questions, any doubts that you may have, we can discuss that. Over to you. Yeah, any questions, any doubts that you have, we can discuss that. Okay. Over to you. Any questions, any doubts? No questions? Tell me, any questions? No, Supreme is clear on this. Supreme is saying no questions. So I'm just hoping that you are on to this. And I'm also hoping that you are revising all of these things that we have been covering up, because otherwise it will sort of accumulate. Huh? So just make sure that you keep revising all of these things. Yeah. So I think Priyanshi is all clear. Great. So again, I would suggest the same thing, that whatever we have covered today, including the previous sessions, so just make sure you revise that. Okay, and we'll whenever we meet next. Okay, so we are going to pick up this P&L part. So with this, we can just conclude our discussion for today. Thanks for your time once again and for this wonderful participation. Okay, so